Hi, everyone. This is the this is the last lecture in Module 5 on source of income. And what I want to do now is talk about the sourcing of intangible property. Income derived from the sale of intangibles is sourced based on the residence of the seller. If the sale is at a fixed price, um, the intangible has not been amortized. This is the general rule of 865A. We will discuss 865D in a second. But again, the general rule is for for intangible property sold for a fixed price that has not been amortized. One looks to, in general, the residence of the seller. So in general, a sale of non-amortized intangible property for a fixed price by a U.S. resident, as specifically defined in 865G, generally produces U.S. source income. Even if the buyer is foreign, the intangible property was used outside the United States. There's a special rule on Goodwill that we'll come to. A foreign resident selling a business located in the United States, on the other hand, for a fixed price that hasn't been amortized, generally would have foreign source gain from the portion of the price properly allocable to the intangibles, again, other than Goodwill. 865 little d in parenthetical, 1 in parenthetical, cap B in parenthetical, creates a special rule for sourcing of sales of intangibles contingent on productivity, use, or disposition of the intangible. And it's sourced just like royalties. And this is covered by 865D1B. Please read that on your own. To the extent that the payments received from the sale of an intangible are contingent on the productivity, use, or disposition of the property, the source of the payments is determined as though the payments were royalties. 865D2 defines intangibles to mean any patent, copyright, secret process, or formula, goodwill, trademark, trade brand, franchise, or other like properties, or an expansive definition of intangible. Professor Loken points out in 73.6.5.4 that pursuant to section 865 little d in parenthetical, 4 in parenthetical, if the taxpayer has been allowed amortization deductions, for example, under section 197, with respect to the intangible, the rules for depreciable personal property under 865C apply to the amount of gain equal to the deduction assigned to the gain to the same source as the income against which the amortization was deducted against. But again, that only applies to the depreciation recapture. For gains in excess of depreciation recapture, in general, you'd look to the residence of the seller. There's a further special rule for the sale of goodwill contained in 865D3. This was used by the taxpayer unsuccessfully in the International Multi-Foods versus Commissioner case that I've asked you to read and brief. So please read and brief that. This applies to goodwill that hasn't been amortized. Let's just, under 865D3, you look to where the goodwill has been generated. Let's read 865D3, get it in front of me. It's a special rule in the case of goodwill. To the extent that this section applies to the sale of goodwill, payments and consideration of such sales shall be treated as from sources in the country in which the goodwill was generated. So it's an exception to the resident of the taxpayer rule, otherwise found in 865D. Professor Loken points out in 73.6.5.4 that if an intangible is sold for a price that is partly fixed and partly contingent on the property's productivity, use, or disposition, gain subject to the intangible rules is bifurcated. So the fixed payment, other than goodwill, is sourced under the residence rules, whereas the contingent consideration is sourced like royalties. And in 73.6.5.4, second paragraph, I think it's the third sentence, Professor Loken gives an example of this. For example, if a non-resident alien not engaged in business in the United States sells a U.S. patent, and let's assume hasn't been amortized, to a domestic corporation for $100 plus an annual payment equal to 2% of the corporation's revenues from goods produced under the patent, a gain on the $100 payment is from foreign sources because of the taxpayer is a non-resident, and it thus is exempt from U.S. tax. Again, 865A places says that the seller's residence is the place of the sourcing, and this is a non-residence. The annual payments, in contrast, are from U.S. sources under the place of use rule for royalties and are therefore subject to the withholding tax imposed by 871A. Let's talk about the International Multi-Foods versus Commissioner case that I've assigned you to read and to brief. I want you to read and brief this and the Boulay case. But I think you've learned this already, but in terms of briefing a case, what I'm looking for is for you to tell me the facts of the case, tell me the issue or issues, it should be in the form of a question, where the answer is generally yes or no, the holding, which is the answer to the question, and the rationale or reasoning of the court in reaching its decision. Well, in the International Multi-Foods versus Commissioner case, as maybe hopefully you've read already, a franchisor of Mr. Donut Shops sold its Asian and Pacific operations to a Japanese buyer. The seller allocated almost the entire proceeds to a combination of goodwill and a covenant not to compete. If this allocation had held up, the bulk of the resulting gain would have had foreign source under 865D3, because under 865D3, goodwill is sourced where it's generated. The covenant not to compete, you look to where the covenant, what areas the covenant covers. Here it covers outside the United States, the Asia Pacific region. So to the extent that it's allocable, truly allocable to a covenant not to compete, that would also be foreign source. The tax court, however, following long-standing precedent in the domestic setting, held that goodwill inherent in the Mr. Donut businesses in the Asian Pacific was embodied in the franchise, meaning in this case, the seller's interest as franchisor and the trademarks, and therefore was not a separate asset and not covered by 865D3. The court sourced the goodwill as being associated with trademarks and franchises. And so thus it was not sourced pursuant to the special rule of 865D3. And let's read a little bit from the case. I'm sorry about that. My wife is picking it up. Good. I apologize for that. It's page 13 of my printout of the case. But in terms of where you can find it, if you look in the opinion section under number 1, Goodwill, let's turn to, I think it's the 3rd paragraph. This is the essence of the court's reasonings. Petitioner's argument, Fisher being International Multifoods, argument equates goodwill with the other assets listed in the definition of intangible in section 865D2. The court has recognized that intangible assets such as trademarks and franchises are inextricably related to goodwill. I'm skipping the citations. However, we believe that Congress's enumeration of goodwill in section 865D2 as a separate intangible asset necessarily indicates that the special sourcing rule contained in section 865D3 is applicable only where goodwill is separate from the other intangible assets that are specifically listed in section 865D2. If the sourcing provision contained in section 865D3 also extended to the goodwill element embodied in the other intangible assets enumerated in section 865D2, the exception would swallow the rule. Such interpretation would nullify the general rule that income from the sale of intangible assets by a U.S. resident is to be sourced in the United States. So please read that on your own, read the case on your own. But that's the most important part of the reasoning of the decision. How could the taxpayer have succeeded? That is, source the income foreign, which is what it wanted to do. Again, the case involved mostly, I think, 902 credits, which no longer exist. But needed sufficient net foreign source income. But how could they have succeeded? Well, they could have done this instead of getting a flat fixed consideration. That is, it could have sold the intangibles for a contingent consideration. And recall, contingent considerations, that is, say the price could have been 8% of sales or 7% of sales. That is sourced like royalties. And that would have generated foreign source income because it's being used outside the United States. So from a tax standpoint, that would have won the day. There would be obviously more risk to the seller because the consideration is contingent. Suppose the buyer does a very poor job with the business, and sales decrease, then the purchase price will decrease. So you've got to weigh the tax considerations, with other commercial considerations. The amount allocated in terms of covenant not to compete, that is clearly foreign source. They were correct in saying that. The issue was they allocated what the court found was too much to a covenant not to compete, and the court, I think, reduced the amount allocated to the covenant not to compete to $300,000. Nobody has to read it, but I do have an article that addresses the case. An article I wrote for corporate taxation. It's called Sourcing of Goodwill. If you go on the PACE portal to, this is, I think it was written in 2012. I think it's the September-October issue of corporate taxation. You do not have to read this article, but you can get it through the checkpoint. When you look, it'll have a, if you go to checkpoint and you look to WGNL or journals, or I don't know, it's a G&L journal, just journals. One of the journals is corporate taxation. So you can pull it that way if you want. But again, nobody's forced to read this article. It won't affect your grade. Again, if you have questions about the case, by all means, email me. Let's turn to, hold on one second. I wanted to cover something else. I just missed it. Let's turn to section 865F, which is covered in 73.6.5.5. The essence of 865F is as follows. If a U.S. corporation sells stock in an affiliated foreign corporation actively engaged in a trade or business in a foreign country, the sale gives rise to foreign source gain if the sale occurs in the foreign country and if the foreign corporation has derived more than half of its gross income during the preceding 3 years from the active conduct of a trade or business in that country. An affiliated foreign corporation is one connected to the selling U.S. corporation by common ownership, directly or through the group of related corporations of 80% or more. This allows the U.S. corporation's foreign source income from sales of stock of their 80% or more foreign subsidiaries. This treatment of gains from the sale of foreign corporation affects the practical matter only gains attributable to unrealized appreciation in their assets. The source from the gains of sales of controlled foreign corporations attributable to the earnings and profits is determined under section 1248 as though the gains were dividends. And we discussed the fact that under 1248 J and 245 Cap A, you meet the requirements of these provisions, under 1248 J and 245 Cap A, the earnings will not be subject to the earnings, and the dividend attributable to the earnings and profits will be not be taxed. Loken illustrates 865F in 73.6.5.5. I think it's the second sentence. For example, if a domestic corporation P is a sole shareholder of a foreign corporation F, which carries on manufacturing operations in foreign country X, gain on P's sale of F stock is foreign source income if more than 50% of F's gross income for the preceding 3 years was from the country X business, and the stock is delivered to the buyer in country X. If any of the 5 requirements is not met, the gain is from U.S. sources under the residence rules. In lieu of 865F, one might consider other options, by the way, to give you a better, potentially a better tax result. If the foreign subsidiary is checkable, that is, if you can treat the subsidiary for U.S. tax purposes as a foreign branch of a U.S. company, then that might give you a better result. You can, make this election, even if you do this entirely for tax purposes, and you could do it, at the time of the sale. There's a case in your book, Dover v. Commissioner, talking about that. I think it's in footnote 52 in paragraph 69, 4.4. So it's, so 865. So when you're considering that 865F would generally give you Foreign source income, you meet the requirements, but passive, you might think of doing something else like checking the box. The last item I wanted to cover is 865 little e in parenthetical, 1 in parenthetical, and that's covered in your book in 73.6.5.7. Let's read that. The caption is U.S. resident with foreign office. Under 865E1, income or gain of a U.S. resident on disposition of personal property is from foreign sources. If one, the taxpayer is an office or other fixed place of business in a foreign country. 2, the income or gain is attributable to the foreign office. 3, a foreign income tax of at least 10% of the income is actually paid. And 4, the property is not inventory, depreciable property, an intangible or stock of a foreign affiliate. Because of these many restrictions, the rule has limited application. It gives a foreign source characterization to gain on a sale of portfolio investment. For example, if the property sold was temporary investment of working capital of a business carried on through a foreign office, and the gain is subject to substantial tax in the country in which the foreign office is located. Substantial means that 10% or more. I'm done now with Module 5, the source of income. Module 6 will come back to foreign tax credits. So have a great day, and if you have any questions, please feel free to email me. You take care, everybody. Bye.